All right, guys, let's quickly take a look at this big batch of US data we've got coming up at 1:30 UK time. We've got everything from export import prices to claims data. We've got the Philly Fed data, retail sales data. Obviously, in the current context and after the most recent NFP jobs report, a lot more of the focus will fall on the initial claims and continued claims data, where the markets wants either further confirmation of what we saw last week, which showed a recovery in claims data, which eased some of those concerns about the labor market, or potentially seeing claims data living up to its noisy self and pushing right back up to those highs. The markets will be keenly focused on that to get a little bit of a sense of the real-time outlook for the labor market. Then attention will probably fall to retail sales, where there will be slightly additional focus on the consumer, obviously with all the question marks about US growth, about the consumer, about the job market. Retail sales will be important for July. As always, though, it's an extremely noisy data point. I mean, take a look at the core measure all over the place for month over month. Take a look at the headline number. It's just such a crappy, noisy indicator, this one. But there will be slightly more attention, we think, on this, just with all the context that's going on surrounding growth as well as the labor market right now. So it's going to be one to watch. As always, though, when it comes to retail sales, and because we know it's so noisy, whatever we get with the actual number, whether that be a big beat or a big miss, what we don't want to see is to have revisions which counteracts that print, right? So whatever we get, let's say this is a big miss or a big beat, we ideally want to see either no revision or a revision that comes in the same direction as the actual number. We don't want to see an opposite print. So let's just assume, for example, we get month over month printing at 0.5. We don't want to see a negative revision to the prior number on that, because it mitigates the size of the beat, and vice versa for a miss. So whatever we get in this column, we either want no revision to that number, or we want a revision in the same direction as the actual. Otherwise, we can just ignore the retail sales data, because that makes it really tricky to trade when you have that amount of noise. So that's very important to understand. Now, in terms of the actual, what's interesting here from the markets as well, is that the equity markets have been able to respond, or let's say rather recover fairly well after their recent lows, right? If you look at the equity markets, you wouldn't say there's a lot of stress anymore about growth, about the labor market, right? But there's three areas in the markets which is definitely still focused on that, it would seem. The first one is yields, which remains fairly close to recent lows. The other one is the US dollar, which remains fairly close to recent lows. And the other one is interest rates markets. I mean, money markets are still very aggressive here in terms of Fed cutting bets. There's still 103 basis points implied by the end of the year. That's a lot, right? There's give or take 33 to 35 basis points implied for every one of the upcoming meetings. Now, that is obviously 100% probability of a cut for those meetings, but it's also about a 70-odd% chance of a 50 basis point cut at either one of those meetings. So it's just very aggressive. And those are the three markets which seemingly hasn't responded to the positive data we've had following the NFP. Equities have responded well to it, but the other markets have just kind of ignored it, which has been quite interesting. We don't normally see that type of divergence between the markets. I'm not sure what it means, to be honest. Might just be the fact that equities normally recovers well out of these types of things, more so than other markets. That might be the only thing going on here. But I thought it was quite interesting to note that equities, out of all of them, have responded fairly well. The other markets like yields and the dollar and money market seems intent on pricing in these aggressive cuts for the Fed. And we heard from Bostic just overnight, who said that does not sound like a person who's ready to cut 50 basis points at a time, But anyway, it is what it is. Let's quickly take a look at the trade plan for today and see what type of numbers we're looking for. Now, keep in mind, when it comes to claims data, the higher the number is, the worse it is, right? The lower the number is, the better it is. That's why for a dovish outcome, we'll be looking for high numbers. For a hawkish outcome, we'll be looking for low numbers. In terms of retail sales, it's what we would normally look at. Low being bad, high being good. Now, in terms of the numbers, as always, when it comes to these things, we like to look at not just the market expectations, but also look at the prior data, look at the minimum and the max. And in some cases, if we think it's worth it, also looking at the forecast distribution to see if there's any weird outliers. Now, even though it's always worth doing so, and I can quickly pop up the ones for claims data, I don't think we need to go too deep into the forecast distribution for claims, at least. The reason for that is, even though we can clearly see massive outliers here for the min and the max, if you look at the chart, because this thing is so incredibly noisy, I don't think we want to try and be clever with this by looking like NFP for numbers that might not be as, basically looking for something just outside this threshold over here. I think we need to be looking for something below the low and above the max. I really think we need to do that. Let's keep it simple. It's crazy noisy. So even though the market's maximum is 245, I'll be looking for anything below the prior print, because I want to see all of that gains that we had with last week's print. I basically want to see that mitigated. I want to see all of that wiped out, and for this thing to jolt right back to the upside. That'll give the market some reason to be cautious, because then they'll start to look at this as a trending move to the upside, saying that, yeah, we're going to have this weird weekly spikes lower, but if this thing starts trending to the upside like we're seeing right now, that's going to be a concern for them. So even though max 245 or higher could be good, I will ideally want to see this thing printing back above that prior high, right? That came in at 250. So in terms of what I'll be looking for is 251 or higher. I think will be good for a dovish outcome. In terms of a hawkish one, again, I'm going to keep it simple there. I'll just be looking for a number that goes below the prior. Below the minimum. The minimum comes in at 223. That's also the low going back to earlier parts of July. Anything below that should be a welcome sign on the hawkish side for market, saying, yeah, it wasn't just noise last week. This thing is moving back down. That's what the bulls on the equity side at least would like to see. So a number 222 or lower, I think that should be able to do the trick. In terms of continued claims, we don't have to be as aggressive, but for the sake of keeping it practical, I'll be looking for a number just above the max. Anything above 1875, it's already going to be a new cycle high. That in itself should be enough, but it hasn't really been enough in recent weeks, unless claims data has shown the same, right? So ideally, we would want to see something that's above the max. So I'm going to keep it really simple there, looking for a number above 1.902. And in terms of a miss, I want a number that comes in at or below 1840. Why 1840? It's the same numbers we looked at last week. I just want to see it taking out these recent lows going back to the month of July. If we can see this breaking lower aggressively, I think that should ease a lot of concerns about continued claims and about the labor market as well. So I think that should be good for a hawkish reaction. In terms of retail sales month-over-month and quarter and core month-over-month, there we can look at the forecast distribution, because there it's a little bit more handy. But just take a look at this. It's all over the place. Oh my word. Tell me you don't know where retail sales will land without telling me. It's just, the markets have no clue with this thing because it's so noisy, right? I don't blame them. Let's take a look at the headline then. Here we go. So in terms of expectations, the prior print for this came in at 0% flat, right? Markets are expecting this to bounce up to 0.3. Look, I'm going to keep it simple on this one. I want a number that comes in below the minimum, even though a number at 0 could still be fine. That's in line with the prior. And ideally, we want to see it going below the prior. But even at negative 0.1, even though that would be below the prior number and in contraction, we want something a little bit more juicy for a miss. We want something, at negative 0.1, it's going to be negative, but the markets might be able to discount that still because of the noise. Take a look at how wide the one standard deviation move is on this. So I think I want to see below minimum there to give me ease about a miss. Something that comes in really aggressive. That'll be below the min, a contraction, and it will be below the prior. In terms of a hot number, this one was a bit more tricky, to be honest, because ideally we would want to see it above 0.9, which is the max, right? But geez, going from flat at 0% all the way up to 1%, that's a monster jump. So it's also a one standard deviation range high. So there I'm playing a bit more conservative. I'll be looking for 0.7. It's just outside the bulk of this distribution. So 0.7 or higher, I think will be seen as I think that the markets will think about what the markets will think about that, right? They've been concerned about growth. They've been concerned about the labor market. If we can see claims data pushing lower more aggressively than last week, or just as aggressive as last week, and then retail sales comes in with a month-over-month 0.7 number or higher, I think that can ease a lot of concern. So I think that should be good enough for a beat. In terms of the core number then, a little bit more tricky once again, because ideally we would want to see it below the minimum. But because the market is so evenly skewed in this print, I mean negative 0.4 plus 0.4, I'm comfortable with this coming in just as a contraction at negative 0.1. The prior print for this, remember, was 0.4, right? It was quite a high number. So if we go from 0.4 plus 0.4 to a negative, that's a lot more negative than us going from 0 to just negative 0.1, like with the headline number. So I think anything that's at or below negative 0.1 should do the trick for a miss. Obviously, if we can get even bigger than that, great. But I think that might be fine to give a reaction on the dovish side. That'll be a contraction and obviously well below the prior. In terms of the beat, this one was fairly simple. Even though 0.4 is an outlier, it's right on the prior. We don't want to see it coming in at the prior. We want to see it coming in above the prior. So 0.5, that will give us above the prior as well as above the max. And those are the numbers that I'll be looking for. Those are the four main numbers I'll be looking for. Now, keep in mind, we have many other data points coming out. We've got the retail control coming up as well. We've got the Philly Fed Business Index coming up at the same time. Ideally, the main focus will be on obviously claims and retail sales, but ideally we want to see the other prints coming in the same direction. So let's just say claims and retail sales comes in good. We would prefer to see more, as many as possible of the Philly data coming in good as well. Or if these two comes in really bad, we want to see the Philly Fed coming in bad as well. What we don't want to see is like super hot jobless claims numbers and then very bad retail sales data. And vice versa. We don't want to see a mixed print. It needs to show us the same thing. Doesn't mean that each and every single one of them has to be super green or red. Just means that the majority of them needs to be either really bad or really good to give us conviction to want to trade this. Remember, both of these two data points we're looking at is they are known for their noise. So we want to see a number that's punchy enough to get the market's attention, but not so punchy. Punchy enough to get the attention, but not punchy in opposite directions, right? It needs to show us the same thing. Otherwise, it's just going to be messy. Now, in terms of expected reactions, remember when it comes to equities right now, it's slightly different compared to what we've been used to over the course of the last few months. What we saw happen from the ISM manufacturing PMI 2.5 weeks ago, we started to see equities trade more cyclical to the data, at least to growth and labor data, meaning that where bad data was normally good for equities and good data was normally bad, we are now at a stage where when it comes to labor and growth data, good data is good and bad data is bad. So that's important. It's still counter-cyclical when it comes to inflation data, like we saw yesterday with CPI and obviously with PPI earlier in the week. But for growth and labor data like we have today, labor data and growth data, it's cyclical, or that's at least the expected reaction. So on a super, super bad number, we expect equity pressured to be pressured on that. If it's a really good number across the board, we expect equities to do okay with that. When it comes to gold, you'll see that I've put a sideways on all three of them. I just don't know where this thing is going to go. It's gone up on good data, down on good data. It's got very little correlation with the dollar or yields or real yields. Gold is just, it's got a mind of its own right now. I haven't been comfortable trading it. I'm still not comfortable trading it. And quite honestly, I don't know how it's going to react. It should react more in line with equities, but I think the fact that equities have changed the way that it reacts, maybe it's taking gold a bit longer, at least from a tradability point of view, to do the same. I don't know. Gold is a messy one for me. I don't have conviction trading that, and I don't have conviction in calling in which direction I think it will be reacting to. The other one just to keep in mind, and I don't think we are there yet, but keep the dollar smile theory in mind with regards to the dollar and yields reaction, at least the dollar specifically, because unlike any other currency, when the US economy goes into a recession, the dollar strengthens. That's not the same for any other currency. If you've got a recession in the Eurozone, the euro plummets. If you've got a recession in the UK, the pound plummets. When it's a recession in the US, the dollar actually does well from a safe haven point of view. So there is a threshold in this cycle that we're in right now. There will come a day, it might be this day, we don't know, but there will come a day when the data gets so bad that the dollar sells off initially and then ramps higher from a safe haven point of view. We want to keep that in mind as a potential risk for trading the dollar on really bad data. Because even though it's shown us cyclical reaction over the course of the last 2 weeks, that can change, and it won't be a surprise when it does, because if the data is bad enough, that's what we would expect to see from the US dollar. So just keep that in mind as a weird caveat in the back of your mind. If we see super bad data, like so super bad data, that the market starts shouting recession from the rooftops, we might actually see the dollar reverse downside and push back up if that's the case. So don't be surprised if that happens. Be ready when that happens to get out of any dollar shorts if that's the case. So in terms of tradability, I'm going to do this the exact same way that I was planning to do the other data that we had this week. In terms of the only swaps that I've done is I've swapped out euro dollar long on a dovish outcome for Aussie dollar long. Why? Because obviously the Aussie, let me just quickly show you guys here. The Aussie is the strongest currency on the session for today. The only caveat to that is that if the data is really, really bad and equities push lower as we expect them to, that might actually drag the Aussie lower alongside it. So even though I prefer the Aussie on the long side versus the dollar on a dovish outcome, the euro might be a safer bet. It's not as strong as it was yesterday, but just keep in mind that if we expect equities to go down, which we are, because we're only expecting counter-cyclical and inflation data, cyclical for today, we might actually see the Aussie pushing lower alongside equity. So either Aussie or euro could be fine. I only put in the Aussie here because it's the strongest on the session, but the euro, I wouldn't mind trading either one of those. And then the other option is just, if you want to keep things really simple and you can trade it, dollar index shorts might just be the easiest way to go about it. In terms of a hawkish outcome, the exact opposite. They'll be looking for ES long as opposed to ES short. We'll be looking for dollar long as opposed to dollar short. And the only difference there would be Kiwi dollar short, based on yesterday's RBNZ policy decision that we had. Now, in terms of levels that I'll be looking for, let's start with the ES. Keeping it nice and simple, we are now above that huge key level of resistance. So from a profit taking point of view on longs, if we get really good data, up to 55.20 seems apt. If we've got nice confluence there, the prior swing area, we've got the implied volatility high. 5,500 though will be a key psychological level to check just before we get into that zone. So that'll be that whole area will be important to watch. And then to the downside, we've got 5,400 marrying up nicely with the implied vol low, and we've got it marrying up nicely with these price swing points. So those two areas will be key, I think, in terms of profit taking for both longs and shorts. In terms of the US dollar, similar story to yesterday. We looked at that prior high around 103. We've got that same area, the same implied volatility level. So this zone will be important for profit taking on longs. To the downside will be 102, implied vol low, coming in close to the low from the 5th. Very, very similar to what we had yesterday. In terms of the Aussie and the euro then, again, either one of these two could do fine. But I am a bit cautious about the Aussie if it is a dovish outcome, because it could be dragged lower by equities. But let's just say you're going to trade either one of those. Look, we want to clear the high from yesterday on this, and then potentially look for a pushback up towards 66.86. We've got the implied vol high coming in at 66.70. It's a bit messy, but within this range, I would say between 66.70 and 66.80 could be a good area to aim for. And then in terms of the euro dollar, same as, it's going to be tricky. Same as yesterday, let's aim for the implied vol high. We've also got the high from yesterday coming in at 110.46ish. So I think that'll be a key level to aim for possible profit taking as well. I won't really be anything above that. Look, if we clear that, we could see this push even higher, but that'll be a first area that we'll need to clear to give me conviction that we're carrying on to the upside. So those are levels. That's the numbers that we're looking for. And as always, any questions, don't hesitate to let me know.